The 2025 housing crash is no longer a grim prediction whispered by pessimistic economists in obscure forums. It is here. It is tangible, cold, and relentless. In various American cities, the scenario unfolding on the streets goes far beyond a simple market correction. We are witnessing entire communities being buried under foreclosure numbers that bring up disturbing memories of the worst days of 2008. But unlike that collapse, this is not just a story about prices going down on spreadsheets. It is a living chronicle of watching entire local economies start to unravel in real time, thread by thread. The most unsettling aspect of this new crash is not the red numbers, but the denial. It is alarming to see how many people still cling to the fragile belief that this is just a temporary dip, a hiccup on the chart that will magically correct itself. They are wrong. Today, we are not just looking at statistics. We are traveling into the heart of the storm, touring cities where home values are not sliding gently, but plunging. In some cases, property values have been cut in half. We will show you where the bubble burst with violence, where homeowners now find themselves trapped in negative equity traps, and why, for many families, the American dream has been quietly repossessed by the bank. Number 8. Boise, Idaho. Do you remember Boise? Until recently, it was the quiet, golden success story of the Mountain West. It was the perfect refuge, the place people fled to in search of space, breathtaking landscapes, and, above all, reasonable prices. Boise sold a promise of a quiet life, far from the chaos of coastal metropolises. But then, the national spotlight turned to it, and the city changed forever. Between 2020 and 2022, Boise didn't just grow, it exploded. Home values soared more than 70% in a frenzy fueled by buyers coming from high-cost states, desperate to buy anything with 4 walls and a backyard. But now, in mid-2025, that tide has reversed with a violence few predicted. Prices have fallen close to half from their insane peaks, with median values plummeting from the mid-500,000s to the high 200,000s in many areas. The drop is dizzying, but the core issue is structural. Many buyers paid prices completely disconnected from local economic reality. The great illusion of Boise was built on remote work. New residents brought big city salaries, but those jobs were never truly rooted in Idaho's economy. When tech companies began to pull back and remote work policies tightened, the foundation of this housing market crumbled. Boise was left with an inventory of homes whose prices reflected temporary demand, while local wages remained stagnant. The result is visible in the new subdivisions on the edge of town, where rows of modern homes built in haste now sit underused. Some have already gone through foreclosure. Others are being sold at brutal losses, with individual owners watching 6 figures of equity evaporate into thin air. Not even the rental market offers refuge, as rents have fallen while interest costs and insurance have risen, squeezing investors who bet on the city as a hidden gem. Number 7. Las Vegas, Nevada. Las Vegas has always been a city that embraced risk. It is in its DNA. But the most recent and dangerous bet wasn't made in the casinos of the Strip, but in the residential neighborhoods ringing the valley. During the recent boom, the median home price climbed to nearly $475,000, driven by investors and second-home buyers competing for limited supply. It seemed Vegas had reinvented the wheel of fortune, but by 2025, the house won, and the homeowners lost. The median has fallen to the high $200,000, a devastating drop of about 60% in some segments, and many analysts believe the market has not yet found the bottom. In the post-pandemic surge, there was an explosion of properties destined for short-term rental, with investors buying homes and condos with the certainty of constant tourist income. When travel patterns shifted and competition increased, many of those units lost their edge. Occupancy softened, and owners discovered their projected returns no longer covered mortgages and maintenance. At the same time, the environmental backdrop became infinitely more complicated. Water scarcity and record heat attracted national attention, causing insurance costs to skyrocket as environmental risks became impossible to ignore. Utility bills in the hottest months now drain family budgets. In new subdivisions on the outskirts, partially completed projects stand as monuments to plans that no longer match current demand. Hospitality workers, the backbone of the local economy, face wages that haven't kept pace with housing costs, and many families who bought late in the cycle now find themselves with negative equity, owing the bank more than the house is worth. Number 6. Phoenix, Arizona. In Phoenix, the heat isn't just in the stifling air. It is burning through the housing data. During the peak of this cycle, the median home price in the metro area climbed into the low $600,000, with demand flooding the valley from higher-cost states. Since then, values have fallen drastically, with estimates placing the decline near 50% from that extreme peak, bringing typical prices back toward the low 300,000s. For homeowners who bought at the top, this drop is the brutal difference between having equity and being ruined. The characteristics of the Phoenix boom are now clear. Investors bought aggressively, and builders launched large subdivisions faster than infrastructure could keep up. When interest rates rose, the buying pace stopped. Many listings now remain active for 5 months or more, gathering digital dust, and sellers are forced to accept offers far below asking prices, offering every type of concession to get a contract. The environmental scenario adds a unique pressure here. Phoenix regularly experiences triple-digit temperatures for long periods, pushing energy costs to unsustainable levels. Power companies have adjusted rates upward due to infrastructure strain, and the water supply from the Colorado River has come under severe scrutiny, restricting new developments. Insurers are also recalibrating their appetite for risk, making policies more expensive and with limited coverage for extreme heat. Investors who once drew up optimistic projections now find holes in their spreadsheets. Phoenix was marketed as an affordable alternative with sun and space, but recent buyers are discovering that affordability depends on stable costs that no longer exist. The mirage of cheap living in the desert has evaporated. Number 5. San Francisco, California. San Francisco was once the untouchable symbol of unstoppable tech wealth. For years, the idea that home prices here could fall significantly seemed like economic heresy, but in recent years, that belief has been shattered. From a peak median price near $1.6 million, values have slid to under $900,000 in many parts of the metro area, a stunning correction of over 50% in some segments. The direction of movement has fundamentally shifted, and the psychology of buyers and sellers has shifted with it. A prolonged shift to remote work left many downtown offices underused, creating vertical ghost towns. Commercial vacancies soared, and residential buildings felt the immediate impact as downtown amenities diminished. Buyers who once paid a premium for proximity to major corporate headquarters now question the value of those addresses. When teams are dispersed, neighborhoods that depended on office crowds had to adapt or close. Residents who stretched financially to buy small homes or condos at peak prices are feeling the crushing weight of taxes, association fees, and insurance that didn't fall as quickly as market values. In some buildings, monthly HOA fees can enter 4-digit territory, while essential upgrades still wait to be completed, creating an impossible equation for owners without capital. The risk of wildfires in nearby regions has also shaped the insurance landscape, with providers tightening criteria or exiting certain areas. The combination of high expenses, changing work patterns, and public safety concerns has pushed more owners to consider selling at a loss. San Francisco's story is now about what happens when real estate speculation collides with real-world limits and infrastructure strain, raising profound questions about who can remain in the city and what kind of economy it can sustain in the future. Number 4. Myrtle Beach, South Carolina. At first glance, Myrtle Beach still tries to sustain the image of the classic American coastal playground. Wide beaches, towering resort towers, golf carts buzzing through the streets, and the flow of visitors paint a superficial picture of vitality. During the pandemic era, this city became an irresistible magnet for real estate speculation. Buyers from all over the country rushed to snap up beachfront condos and short-term rental properties, confident that tourism revenue would cover the bills forever and still generate a profit. It was the promise of perfect passive income. But since 2023, that confidence has been tested to the breaking point. Home values have fallen more than 45% in many segments, turning what was a wave of rapid appreciation into a steep and dangerous slide. Many owners today find themselves with far less equity than planned, trapped in assets that lose value month after month. The recipe for this disaster is familiar, but lethal. Too many investors chasing the same strategy, identical properties flooding the market at the same time, and a growing list of expenses that devours any profit margin. Some homeowners association, HOA, fees now reach hundreds of dollars a month, eroding profitability. Even in buildings with maintenance backlogs and aging infrastructure, owners report significant equity losses while still being forced to write fat checks for ordinary fees, special assessments, and emergency repairs. Cash flow that once looked comfortably positive on paper is now dangerously close to zero, or worse, in the red. Insurance has changed the game completely. Growing concern over hurricanes and floods has driven premiums to stratospheric levels and, in some cases, led insurers to cancel coverage after relatively modest climate events. For an investor operating on thin margins or a retiree on a fixed income, this jump in costs has transformed the dream of a beach house into an unsustainable financial liability. Number 3. Salt Lake City, Utah. Salt Lake City drew national attention as the affordable, sensible alternative to West Coast markets. For a time, it seemed like the perfect compromise: stunning scenery, an emerging tech sector dubbed Silicon Slopes, and prices far lower than California. Between 2020 and 2022, home values surged an absurd 75%. Since then, reality has taken its toll, and values have fallen more than 40% from that peak, pulling the median price from around $620,000 to the $300,000s in many areas. At the height of the boom, remote workers and newcomers bid aggressively, paying above asking price even for modest properties. Builders responded by pushing new projects in the suburbs and foothills, confident that demand would be eternal. But when interest rates rose and corporate hiring slowed, the tone changed drastically. Listings that once received multiple offers now remain on the market for weeks and months. The rental market downtown and near the university campus has also softened, with property managers offering months of free rent and gift cards to attract tenants, cutting directly into owners' returns. Beyond the economy, environmental risks add a layer of existential anxiety to the market. Concern over wildfires in the foothills has grown as summers become hotter and drier. An earthquake risk has become a frequent part of insurance conversations. Community associations in suburban neighborhoods have become stricter, enforcing rules that add fees and tension. Salt Lake City's turn from hidden value to overvalued and then to correction was fast and brutal. It forced residents and planners to rethink how much growth the region can absorb and whether local infrastructure, especially water supply and air quality, can sustain the weight of such speculation. Number 2. Naples, Florida. Naples has always represented a specific golden version of Florida luxury. Meticulously manicured neighborhoods, exclusive golf communities, and waterfront properties attracted wealthy retirees and second-home buyers from around the world. At the peak of the recent cycle, average prices in some parts of Naples reached $1.1 million. Since then, values have fallen drastically. Many homes now sell for close to half their previous numbers, and certain high-end condos have seen even steeper declines, challenging the assumption that prime coastal property always appreciates. Severe storms exposed the fragility of this luxury model. Hurricane Ian and other weather events caused extensive damage, driving up the cost of rebuilding and bringing renewed attention to flood and wind risk. Insurance premiums in Collier County have climbed dramatically since 2023, in some cases tripling in just a few renewal cycles. For many owners, policies that once cost a few thousand a year now enter five-figure territory, pressuring retirement budgets and investment plans. Citizens Property Insurance, the state-backed insurer of last resort, has seen demand explode, meaning more families are carrying expensive coverage or accepting inadequate protection. Naples is also dense with gated communities with rigorous associations. Substantial monthly fees and special assessments for seawall reinforcement, roof replacement, and clubhouse renovations translate into large one-time charges. For those who bought at the peak expecting low-maintenance coastal living, the combination of falling values and rising costs came as a shock. Golf courses and resort-style amenities still look impressive in photos, but behind the scenes, more owners are quietly listing their properties, hoping to get out before conditions worsen or another storm hits the coast. Number 1. Palm Springs, California. We end in Palm Springs, the desert city that became a global symbol of mid-century modern style and warm weather escape. During the pandemic surge, home values here climbed to unbelievable levels, with median prices nearing $1.2 million in early 2022. In 2025, those same medians have fallen to the $500,000 range in many areas, a decline of more than 50%. In some zones focused on short-term rentals, the drop has been even larger, wiping out years of paper gains. During the boom, buyers from Los Angeles and beyond snapped up old ranch homes and bungalows, renovating them into stylish vacation rentals. For a brief period, it worked. But then, heat waves intensified, tourism patterns shifted, and crucially, local authorities tightened short-term rental rules. New permit limits, stricter enforcement, and heavier fines changed the math for many owners who counted on high occupancy to cover their costs. Some discovered their permits could not be renewed under the new rules, turning income-generating assets into empty, expensive vacation homes. Insurance became another critical pressure point. As wildfire risk in the region increased, several major insurers scaled back coverage in California or exited certain markets entirely. This left many families facing higher premiums or limited options, often with policies that include larger deductibles. At the same time, energy costs in a desert climate where air conditioning is a vital necessity continued to rise. The result is a city that still photographs beautifully, but where the economics of ownership have changed radically. Homes that once seemed like safe stores of wealth are now hard to sell, and streets that once seemed full during peak seasons now show more for sale signs than occupied driveways. Palm Springs shows what happens when fashion, speculation, and environmental risk collide, raising hard questions about how much buyers are willing to pay for a lifestyle that comes with rising costs and regulatory uncertainty. Our journey comes to an end, but the pattern is undeniable. From the investor-driven turmoil in Cape Coral and Boise, to the deep corrections in Las Vegas and Phoenix, to the luxury reversals in San Francisco, Naples, and Palm Springs, the message is clear. The 2025 housing decline is not a smooth adjustment. In many of these cities, it is a full-scale reset, exposing how fragile some of the most celebrated markets really were. If you are thinking about buying in one of these places, you cannot rely on past price charts or sales slogans. You need to look at insurance, long-term climate risk, job stability, and changes in local policies. If you already own property in these markets, you are living this reality every day. The dream of homeownership still exists, but in 2025, it demands more than optimism. It demands extreme caution and eyes wide open to the storm that has already begun.